Welcome to the Root Access Show. My name is Martin Omander, and I work in Google Developer Relations with Startup Outreach. In this show, we will discuss common issues and problems that startups have. And in this first episode, we'll discuss getting a seed round of funding. My guest today is Don Dodge, also from Developer Relations. Don, would you tell us what you do at Google?
Yes, I'm a developer advocate at Google. I work with startups and help them be successful using Google technologies to build their applications and their companies. There are about 200 of us that do that, and I've been doing it for about 3 years.
All right. Don, I hear a lot of terms about funding of startups. Angel round, seed round, Series A, Series B. What do they mean? Could you lay them out for us in the life cycle of a startup?
Sure. There's several levels. The first one is usually called friends and family. And it's called friends and family because that's where you get the money. And it's typically $50,000, maybe $100,000 that you would get from your friends or family members. And at that stage, you really don't have a company. You have an idea that you want to pursue and maybe build into a company. So after that stage, you get to the seed round, which is typically funded by angels. So it's sometimes called seed round, sometimes called angel round. That round is typically between 100,000 and maybe all the way up to 800,000 or a million. Angels are executives from big tech companies that have made a lot of money. More typically, they're founders of startups that have sold their company and made a lot of money and are looking to invest in young entrepreneurs and new ideas and new companies. The next level up after the angel round or seed round is the Series A. And it's called Series A because that's the first series of equity capital. So it goes A, B, C, D in the different rounds. Those are funded by venture capitalists or VCs. And those rounds tend to be more like $1 million to $2 million of capital raised, and it's for equity in the company. So they're actually taking stock in the company. Whereas those previous rounds, the friends and family or the angels, those tend to be what are called convertible notes. And they're called convertible because they convert from a note into the Series A equity stock when that happens. So they're quite different. And that's the normal progression.
All right. So let's focus on the seed round. When a company gets to that point when they're starting to look for seed capital, have the founders quit their day jobs yet? Where is the company at that point?
Yeah, at the friends and family stage, they probably haven't quit their jobs yet. They're still working nights and weekends to try to make this happen. By the time you get to the seed round or angel round, one or two of them have quit their jobs and now they're focusing full time on developing this idea. But they don't have much in the way of a team or a product yet. So they might have one or two founders or one founder and a contract coder or something like that to do something. They have an idea and hopefully they have something like a demo or something that you can look at to understand what it is they're going to build. It's getting progressively more and more difficult to raise the money, and the bar is raising. So you have to have maybe not just a prototype, but a working product with some beta users already to get that money.
So let's talk a little bit more about that. If you have a startup and you've gone through the friends and family round, so you have your demo, you're thinking it's time for the seed round, what is the checklist of things you should have before you go out and talk to angels?
Well, you want to be as far along as you can, and you want to take it as far as you can before you raise that first money. Because the longer you wait, the more that you have done, the easier it is to raise money and the more money that you can raise at a higher valuation. That said, when angel investors are looking at a company, they want to see two founders that are committed to making it happen. They want to see a business plan that sort of explains the idea and where it could go. So the investor wants to be able to connect the dots from where you are now to where you'll be to have revenue and maybe have 10,000 customers or hundreds of thousands in revenue. So you don't have to have the revenue or the customers, but you need to have a plan on how to get there. And in most social or easy applications, they want to see users. So they'd like to see the product not in its complete state, but at least enough so that you have some users that are giving you feedback and what they call social proof, where in a social application you have enough users that you can say, okay, I can understand how people will use this.
Right. So what these private individuals rather than companies investing at this point, what kind of companies do they invest in? What are they looking for?
Well, angel investors invest in people they know or businesses that they understand. So a lot of these investors are from startups that successfully sold their companies, or they're from big tech companies where they made a lot of money. So they tend to understand sort of software, technical, web, social, maybe video or mobile or that kind of thing. Investors will tend to invest where they understand the business, where they have some experience, where they can add value. So they know people in the industry that can help, or they know companies that you need to work with, or they have experience in building the companies so they can add value and help you build your company. So angels tend to look for those opportunities, or the flip side of that is they invest in people they know. So people that they've worked with in the past, people who have worked at startups that they know. So those are the two things. They invest in people they know or businesses that they understand.
I see. Do you invest in startups?
I do, yeah. I've been doing it for quite a while. I'm in 25 companies now. I just invested in the last one just last week. And I tend to invest in companies that are doing mobile, social, location, indoor kinds of things, some e-commerce. So it's areas that I've worked in the past and sort of businesses that I understand. And I think that's pretty typical of most angel investors.
How do startups get in front of the right angel investors? It sounds like not any angel is a fit for every startup.
That's right. Well, it usually comes from a couple of different sources. One is the angel investor already knows that person because they worked with them at a previous company, or they're introduced to them by trusted advisors. So someone who knows the startup and knows the angel investor will put them together and introduce them. Those are the two typical ways. VCs can also sort of introduce you to people where they're not ready to put their money in, but they'll introduce founders to angel investors who will put up the money. So there's a variety of different ways, but basically it's either you have to know the angel investor already, have worked with them in the past, or they got introduced by someone that they trust.
What is a startup to do, a startup founder, if they don't know angel investors?
I think the best way to do it is go to other startup founders that you know. So typically you're going to know someone who's in a startup or a founder at another startup, and ask them to introduce you to investors. Or you're going to know investors who have invested in other things and ask them for introductions. So it's really just reaching out to your network of friends and coworkers and seeing if they know investors and getting an introduction that way. The other way is show up at conferences. So conferences like the Launch Conference or Demo or TechCrunch Disrupt or Google I/O or any of these shows that are tech conferences, typically there are a lot of investors there. And if you go to these conferences, you're going to meet people and meet investors, and that's a good way. The third way is you should be writing a blog and writing about your experiences, and people will find you that way. So one of those three ways you can find an investor.
I see. So tell us a little more about this convertible note. What does a deal typically look like? What are typical numbers involved in the seed round?
So a convertible note in a seed round is usually somewhere between $100,000 and maybe up to $1 million that you're raising. A convertible note typically has an interest rate, like say 2 to 4% interest, and it has a discount to the equity. They call it a convertible note because it converts from debt to equity at the Series A. So it might say 2 to 4% interest rate, a 20% discount. What that means is if you raise your Series A at a $5 million valuation, the seed or angel investor gets a 20% discount to that. So 20% discount off of 5 million is 4 million. So you get to put your money in at 4 million while the Series A investor puts theirs in at 5 million. So those are the basic terms. There's also a cap sometimes. A cap means if I put in my money early and you raise a Series A at a $20 million valuation, that's not really fair to the investor. So what they'll say is there'll be a 20% discount to the Series A price or a cap of, let's say, 4 million. So it doesn't matter if you raise your Series A at 10 million, the angel investor is going to get in at a cap of 4 million. So the three basic terms are the interest rate, the discount to the next round, and the cap on the valuation.
It's got to be hard to know what valuation it will be one round into the future.
That's precisely why they do convertible notes. In the past, they used to try to do Series A where you have to establish the valuation that you're going to put the money in. But the reality is it's so early that you don't know what the valuation is going to be.
Yeah.
So a convertible note allows the investor to put money into the company and have a floor and a ceiling on what the valuation will be. So that 20% discount gives them a discount off whatever that valuation is established by the VCs later. The cap also protects them from the upside. So the valuation can go to 10 million or 20 million, but at least the early seed stage investor gets their valuation capped at an amount like, say, 4 million or 5 million.
All right. What should startups look for? Or rather, should startups look for anything in an investor except money? And if so, what?
Yeah, you want people who can help you. So VCs always say that they do more than write a check. They help you build a business. And you want to do the same thing with angel investors. So you want to look for angels who have maybe had experience in this market segment before, or have built a company before, or know people in the industry or companies in the industry that you want to partner with. So you want to look for angel investors who have experience, who have connections, who can help you, give you advice on when to do certain things or how to avoid mistakes. So these angel investors, they call them angels because they help you. They're like angels who descend and fix things for you and help you.
Right. Okay. So you see startups coming and asking for seed investments. What are some of the common mistakes you see startups make when they're looking for seed investment?
Well, there's a couple of mistakes, common ones. First one is they don't raise enough money. So they have fairly modest goals and they might raise 100,000 when they really need 500,000. And raising money takes a lot of time. It's distracting. It takes you away from building the product and building the company that you want to build. So I think the first mistake is they don't raise enough money. So always try to raise twice as much as you think you're going to need, because you're probably estimating wrong. And if you have more money than you need, then life is good. So don't worry about it. Yeah. So that's the first mistake, not raising enough money. Second mistake is taking money from people who can't help you. Then you're not getting the value out of that investment if they're not experienced people who have built a company before or who can make connections for you that you need, introduce you to people, and actually looking ahead to raising that venture capital round, you want your angel investors to be the people who can help open the doors so that you can raise your venture capital round.
Right. So how do you think about what is enough for the seed round? You said it's a common mistake to ask for not enough. How do you determine what is enough?
Well, I think the real question is, what are you going to do with this money? So what milestone are you going to reach? And I think that means that you have to have the product working, you have to have users, or you have to have first revenue. So you need to think of, how long is it going to take me to build this product? How long is it going to take me to get to the first 10,000 users? How long is it going to take me to get to the first $1 million of revenue? And sort of map that out. And there's no correct answer because you don't really know, but estimate how long it's going to take you, figure out how much money you're going to burn between now and then double it, because you're probably wrong. So that's how I do it.
Right. Not multiply by pi.
Well, you could.
Two is enough. Dawn, are you seeing any trends or changes? Is angel investing different now than it was a couple of years ago?
I think there are more angels involved now. AngelList has been a boon to the industry. AngelList is a place where angel investors can view business plans and proposals from hundreds and hundreds of entrepreneurs and startups. So I think there are more angels involved. There's more money available, but the angels are getting smarter and demanding more progress. They're demanding that the teams be more fully developed, that the product be out there at least in beta, or have users that are using it that sort of prove that, yes, this team can deliver. Yes, there are users who are interested in using the product. So I think it's getting a little harder. Even though there are more angels involved and there's more money available, it's raised the bar on the quality and how far you have to be before they write a check.
Is that a good thing?
Well, some would argue that there are too many companies being funded.
Oh.
And they talk about the Series A crunch, where lots and lots of companies get angel funding but then can't raise the Series A. So some would argue that there's too much angel funding. And I don't believe that's true. I think that the more people out there trying their ideas and building their companies, the better off we all are. And yeah, not all of them are going to raise a Series A, but that happens all the way up the chain, where you raise a Series A and they have struggled to raise a Series B. Or
I've been in a startup like that, yes.
Yeah, it happens.
Yeah.
So no, I don't think there's too many. I think more angel investors getting involved and more startups springing up result in more opportunities for big companies to emerge. So I think it's a good thing.
Great. Finally, Dawn, if viewers only remember one or two things about the seed investment round, what is the most important for startups to remember?
Well, when investors look at a company or look at an opportunity, they're thinking about team, number one. So don't go it alone. You have to have at least one other co-founder, and it's all about the team. So have a strong team of people who you have a lot of confidence in, where you have complementary skills, where they cover things that you don't, where you have confidence that you can build this. So team is number one. The second is, make sure you raise enough money. Don't get caught short. And maybe the third thing is, have a good idea of how you're going to produce revenue. The days are over when you could say, we're just going to focus on the product and build audience and figure out how to monetize later. Those days are over. Now you have to have a plan on how you're going to get from where you are today to revenue, so that an investor can connect the dots from where you are to where they want to be.
I've been in one or two startups that were like that. Let's figure out how to make money later. Yeah, it doesn't always work out.
No.
Thank you, Dawn, for sharing your experience with us.
Well, thanks for having me.
Thank you for listening. In the next episode, we'll talk about how you as a startup can get the attention of A-list influential bloggers. Please look at the program's listings for root access on GDL, and see you next time. Bye.